welcome back for this lesson. Today we're going to be talking about funding and creative financing. So we brought Matt on. Matt is one of our founding partners, and Matt's title is the Director of Acquisition. So Matt is the one out there in the field looking for the properties, working the deals, and helping so that all of you have more opportunities on really great locations for your residential assisted living. So Matt's going to talk to us a little bit about funding, the creative financing side, like a lease option, and how that looks once you go for a refi. This is where Matt has spent a whole lot of his career and time in being creative and figuring out how to find money for different things, right, Matt?
Absolutely. That's my specialty.
What do you call yourself? The creative financing solution.
Creative financing, lending solutions, guru, get it done. You know what I mean, guys? So we figure out a way where the banks say no, we'll figure out a way where we can tell them people yes. So that's what I take pride in, is working with owner operators that maybe might be a little confused on kind of how the typical banking process works. It's a lot less hoops to jump through because we know how strenuous that can be when you don't have all your ducks in a row, with pulling together all the financials for having 2 years of tax returns. A lot of those things aren't really applicable to us because we're really working in tandem with you. We're partnering with you as the owner operator, and that's really what makes us different, is that our company is kind of going out on a limb for you to make sure that you are successful. So kind of how that looks when you first get on boarded is we're going to go through and create realistic time frame to find you a facility. I'd say on average, it's taking us about 90 days to find the facility, just to find it. But initially what we'll do is get you pre-qualified. And what that looks like is finding out where you're at in the process. So most people, they are trying to either leave a job or retire, most of our owner operators. So my goal is to set them up for success and to create a realistic time frame of milestones to get them across the finish line. So between getting them trained on your side, Lindsay, and then getting them ready to get qualified, it's an ongoing process. So from a financial aspect, excuse me, from a financial aspect, we have to get them in a position to where they can come up with the 10% down. That's probably the biggest hurdle. So most people, when they go in for lending, they're referred to SBA.
So let's stop there for a second, Max. So let's talk about that 10% down. So if somebody was looking to have this 10% down, and let's just call it, just for easy numbers, 50,000. Say it's a $500,000 property, so you need $50,000. Somebody's not sitting on 50,000, plus then they need extra funding for the startup costs. So we'll talk about that. So let's just say overall they're looking at needing $100,000. They don't have $100,000 cash sitting in the bank. How can they go find $100,000 for the down payment and for these startup costs?
So when they need to find some liquidity, I mean, obviously the best place to find liquidity is amongst family and friends initially, people that believe in your vision. It's going to be your fastest, easiest way to potentially reach into the people that, I guess, believe in your vision. Now, not all of us have those family or friends around us. So that brings us to kind of option number two, and that's going to be alternative lending and low doc lending. Now, in the banking industry, that looks best in a business format. So we encourage everyone to have an LLC established, and if they need help with that, we can get into the formation of creating an LLC for them. But ideally, lenders, because we understand the lending space so well, they're looking for 2 years in business, ideally, with some financials to look at. And for a lot of operators, they don't have that 2 years in business, right? So we can help them navigate that. And we do that by potentially going out and getting an aged entity is one form of doing that. How the entity is registered in the system. So really understanding the lending guidelines and what our banking partners are looking for before we apply. So we get them geared up to where look at it from like a soft pull perspective. We're going to get them pre-qualified, and we go out and get low doc 0% money available to them that they can utilize and leverage that to come up with the 10% down. So we've already kind of found out what banks are the easiest that are most with the least amount of scrutiny and least amount of hoops to jump through, because we know how difficult it is to get approved for an SBA loan. So we create the bridge to get them the financing they need, and then strategically set up their payments so that's auto debited from their account, and we set them up with enough reserves to move them past the finish line.
Okay. What are some other ways that they can come up with money outside of a bank, like credit cards? How can you utilize credit cards to come up with say 50,000?
Yeah, so with credit cards, they are looking at the credit profile, and for most people, that's going to be change person to person. So obviously, the more depth they have in their credit profile, the better chances they have of getting more available credit. So with credit cards being the business credit, and that's why I refer to business credit, because that won't actually show up in their profile. So if they were to pull their credit, they won't actually see that utilization, which oftentimes after you actually utilize the card and benefit from those funds would bring their score down normally if they were to use personal credit cards. So the business credit cards, what's beautiful about that is as long as you have an entity, it's in good standing with the state, and you have a clean personal profile, you're able to personally guarantee business credit cards, which you're able to leverage against your business. And then we can actually take that money off the credit cards and use that for working capital and down payment assistance.
Yeah. And sometimes that involves making phone calls and whatnot too to the credit card companies and really asking for an increase in your credit limits. Where they might only, you fill it out online, they might only give you 5,000, but then you give them a call, you might get that up to 25, 30, 50,000.
Yep. I mean, because we understand the credit card guidelines, I would say on average you're going to receive somewhere between 2 to 3 times what your biggest personal credit line is, because they call it comparable credit. So when you're looking at your credit profile, if you have a Wells Fargo card of 5,000, well, Chase is going to say, okay, we'd be willing to give him, or her up to 3 times that amount if they applied with us. So they're looking at comparable credit, how long that credit, payment history has been established, number of cards. There's what they call a 524 rule in general. So that's what that means is you don't want to apply for more than 5 trade lines over a 24-month rolling time period. So it's a look back period, about 24 months from your last open credit card. So all those things are taken into account before we actually do the applications. But all that is done in our optimized process for getting people financed.
Yeah. Um, so that's really helpful. What are some other ways they can come up with some liquidity, like equity lines?
Yeah, so I mean, there's a number of different ways to potentially pull capital together. I mean, you talk about lines of credit, you talk about term loans, you can talk about HELOCs, home equity lines of credit if you have a existing home. So we're going to look at all those options, right? But obviously, we want to gear people up to be prepared. So we're looking for the low interest, obviously the lowest interest we can find you, with the best possible terms to pay back, because we don't want to put people in a position where they feel over leveraged as well, right? So coming up with a strategy is super important, but I would recommend as the number one would be the business credit cards. It's the low hanging fruit of the industry, where even if you don't own a home right now, you're not out of luck. We can make things work for you and get you that funding that you need.
Yeah. I know there's a lot of banks too that are just offering different personal loans, like $25,000 personal loans, and they're pretty easy to obtain actually right now.
Yeah, I mean, credit in general is pretty giving right now, and the reason being is because of our economic standpoint. I always say, hey, it's better to have it and not need it and not have it, right? So that's the stance we take. Where if you're looking for ways to come up with that initial down payment or have reserves, we're going to come up with the least amount of pushback, so you don't have to jump through a bunch of hoops and to get the financing done and a lot of paperwork. We're trying to avoid all that paperwork and expedite that time. So people that are kind of on the fence, that are like, oh, I need to have 2 years of tax returns and all that, like that's not applicable in this regard. There's also merchant financing. So if you have an alternative business that's showing income on your credit card receipts, they can loan you a percentage Usually it's about 10% of that revenue that comes in on your merchant processing. They're willing to lend you, or top line revenue. So if you have an existing business, they can go off the cash flow of your business, right? So there's equipment financing, there's different ways to get lending, but everyone's situation is different and everyone's needs are different. So we're going to do everything in our power to go out there and find the money that's available, but we never want to put people upside down where it's called predatory lending, where you're never going to be able to pay back the credit card as well. So it's strategically getting the 0% on the front end, giving you 12 to 18 months of runway to basically get your business up and running, get the placement for your patients. So now that cash flow can replace that payment that you're making. You're basically paying the bank back with their own money. You're leaving a percentage of that in your account allocated to make the minimum payments, because that first 12 to 18 months are 0% interest. So there's really not a rush to get the money paid back to the credit card as much as there's more of a rush to get your place at full occupancy and get your building stabilized with patients. That's more important, because that amount of money that is being paid for the credit cards is going to get replaced with rental income after the building is stabilized. So really, we're using the credit card money strategically as a bridge to get you not only into the building, but also being able to pay for your upfront costs. That could be fees, that could be furniture, it could be allocation for different consulting that's needed, and overhead. So as soon as that initial chunk is figured out, then 12 to 18 months is when we're looking to pay that back, and then the income coming in from your facility should replace the income that you got originally from the credit cards.
Awesome. Yeah. What would you say? Because I've had people ask me before, taking money from their IRA.
Okay.
They quit a job and they're sitting on 100,000 in their IRA. What would you say to that in order to start a business?
I mean, I'm not a financial consultant, so I can't tell people to take money, right, from their
You should
IRAs.
have just done that disclaimer at
I
the
should have
beginning. We forgot
disclosed
to
that
put
in advance,
disclaimer.
right? And obviously I'm going to advocate for creative finance, measures. So if you have money sitting in IRA and it's not performing well, your financial advisor might, give me a hard time for this, but you can borrow against it if you believe in this business, because this is a commitment as well. This isn't, hey, pull the money out and go to the beach and watch your bank account fill up. You still have to be actively involved in the business. But yeah, I mean, IRAs are another form you can borrow against as well.
Cool. Okay. Let's use the last couple of minutes that we have here, and let's talk about the creative financing for the lease option. So a lot of people that are going to be watching this and going through our course are utilizing the lease option. So what does that look like then when they go to refi? How many years does it take? What do they really need to obtain in order to get that refi and be able to own the home?
So when we're talking about a refi, the most economical and best company to work with is going to be your local banks. But what they're going to leverage is going to be the SBA product, because that SBA is really a guarantee to the bank that if in the event the operator, being the person doing the borrowing, were to default, that the SBA guarantees that loan to the bank. So the banks don't really have a lot of risk, but I would definitely encourage people to work with a local lender that you have a relationship with. They're going to give you the best terms that can see your vision and see the asset for what it is, because they're going to understand their local market the best. But how a lease option really is set up on our behalf is, after you get signed up and you're in the course and you're going through your certification, but we give ourselves a 90-day runway to go out there and find an existing licensed ALF in their area. And what that process looks like is we'll go out and purchase the facility on our behalf for our clients. So after we've gotten the green light on certain demographics, certain zip codes that they're okay for us buying a facility, we go out and buy the facility, and then the owner operator will be ready by the time we buy that with their 10% down. So they have approximately 90 days from the start to finish to pull together that 10% down, and then they'll have that money that will serve as their down payment against the purchase price. And they have about a 2 to 3 year minimum to purchase the facility back from us. And we give them as much as 5 years to buy that back. And it depends contract to contract how that lease option is written. But basically the goal of it, because the SBA wants to see 2 years of the property being in place as far as the one entity running it to use those financials. So SBA would be the loan that the operator would get to refinance us or buy us out of the contract.
All right, well, that sums that up pretty well, and I'm sure other people will have more questions about it, but thank you so much, Matt, for your time to explain some of these creative financing and funding options.
Absolutely. And if anyone ever has any questions, I'd love to jump on a call and answer it for them, accordingly.
All right, sounds great. Thank you.
Thanks, Lindsay.